Welcome back to Covered Call Corner. I'm Denny Benson. This is my second weekly look at a particular stock and a covered call associated with it. I'll again bring up the caveat that these are my opinions and should not be taken as investment advice. Consult your investment advisor before making any investment. These transactions do have downside risk, and I'm going to show you that at the end of this briefing from last week. All right, the stock that I'm choosing this week is CCL, Carnival Cruise Lines. It's a cruise line. It's what I think is a reopening stock. When people get vaccinated and we get back to normal, cruise lines will be back in the vacation business, as will a lot of travel. And I think that will, a lot of people are really wanting to get out of the house. And cruises are very popular. I want to make the point that a little bit of patience associated with Carnival Cruise Line. They're not scheduled to start sailing again until May 31st. And this one you could roll from week to week over the next few weeks, picking up the premium on the call each week. So let's go ahead and look at the numbers. As usual, we start with our options chain. Remember, we need four things for an option chain. We need the stock and its underlying symbol. We need to look at the calls versus the puts. We need a expiration date. Here it's next Friday, March 12th. This was taken on Sunday, March 7th, And we look at different strike prices. And notice there's a little glitch here in the strike prices. There's a 50-cent gap here, a dollar gap here, 50 cent, then a dollar, then 50 cent, whatever. I've picked most of these. I did not include a 28.50 row in my analysis. Now, again, even though it closed at 26.09, the bid and ask was 26.46. So I'm going to use 26.46 as the purchase price for the stock in doing this analysis. All right, as usual, we'll start by calculating the maximum profit based on whatever call option strike price you pick. Notice the expiration date is all March 12th, so these are just weekly calls. Again, with Schwab, if you purchase it online at the 26.46, there's no commission for online trades. So there's your total purchase price. Here are the different call option strikes. I did skip the 28.50. I have 28 and 29. Here are remember the bid prices for each of those calls. Schwab charges 65 cents per option contract. Here will be the net proceeds. Here's the total amount invested, which is this purchase price minus the net proceeds from selling the call. So you can see that. And then the closing position is the strike price times 100 minus about 20 cents for securities and exchange commission fee, which then calculates the net profit. So again, as you move farther out the risk curve by picking a higher strike price, the more your potential profit is. Now notice the maximum net profit for the 24 call is actually negative. That's because this option price probably reflects that 26.07 price or 26.09 closing price versus the 26.46 that I've used in these calculations. So this option could be a little bit higher, making a net profit a little bit positive, but it won't be very much. So the analysis I'm going to pick is I'm going to choose a $28 strike for this Friday, the March 12th, 2021 call. Chasing about $200. It's a nice 7% gain on my investment. So in a week, that's quite a bit. But to be quite honest with you, I don't expect it to hit $28 by next expiration, but I expect it to be higher than a 26. I want to keep this stock and keep rolling these calls. And at 47 cents, I'm making about 1.6% in a week, just on the call price alone. Let's move on. Here's what the chart looks like. Okay, the blue line represents whatever the closing price is next Friday, if I don't close out the position earlier, what my profit and loss will look like. So my maximum profit occurs at the strike price of $28. Anything above that, I don't make any more money. This dot represents where I would buy it, and if it stayed the same price, I would make about $47, $46, $47, so not too bad. My break-even price then is about $26 even. It's actually just a few pennies less than that. Well, it's right at $26 per share. So as long as CCL stays above 26 for a week, I will have made money. So we'll compare the calls at various prices. Here are the different calls provided and their appropriate prices, showing you the maximum profits related to these. I've picked a 28 call, so at $28 I make about $200. But even at 27, I'll make about $100. So $26.50, I'll make about $50. So these are where I think Carnival Cruise will finish somewhere between $26.50 and $29 next week. If it hits 28 or above, I can either roll the call or just pocket the $200 profit. All right, so my thoughts on why I've picked this. I think Carnival Cruise Lines is a reopening stock. There was a lot of volatility in all the cruise line stocks on Friday. It was because Norwegian Cruise Line, a peer in the industry, issued $1 billion in new equity, diluting that stock. So it sent the price down a lot. At one point it was down like 12 to 14%. Carnival Cruise and Royal Caribbean Cruise Lines were both down around 6% for a while. But then they started rebounding late on Friday. CCL had issued at $27.10 a week earlier a public offering to raise equity in the company to make sure that they could bridge the gap between now and when they start sailing again in less than 3 months. Cruise lines are scheduled to start May 31st here in the United States. And the vaccination rate helps make this possible. With the new J&J vaccine, we were averaging about 2 million vaccinations nationwide last week. I think that rate will increase to 3 to 4 million. I think we're going to have a pretty good population of people that will be eligible to be on the cruises. I think vaccinating beforehand is going to be a requirement. But there's going to be a big enough market for this that I think people are really going to want to get out and go sail on these cruise ships. I am willing to hold and roll the calls moving forward because I think CCL, once it starts sailing again in late May and early June, price this and they see the ships are pretty full and people are willing to spend money on this, I could see a significant upside here. I think it's still a value stock. I think it could move to in low to mid 30s. Remember, before the pandemic, it was over $40 a share. So I think it comes right back close to that. It could skyrocket. Now, at 40, that would be a 50% gain. I can never predict a 50% gain in any particular stock in a 6-month period. But for it to move to 30 or 33, that's 10 to 20%. And I still think it has that amount of upside left in it. So I'm willing to hold and roll the calls. That's why I'm picking higher strike prices. Because if it does make a big jump in a particular week, I'll actually capture most of that jump. So that's the reason why I'm using 28 as my price. So please remember, this is my opinion only. All right. And now with every week, I go over recent activity. And remember, these are my opinion, and sometimes they don't always work out. So I picked Tilray last week, and in a word, it was a disaster. If you remember on Monday, the whole market was up tremendously right from the open. And so because I had recommended the stock, I felt like I was sort of obligated to chase it at the Monday open, and I paid $25.82 each for 2 blocks, 200 shares, and I sold the $26 strike at $1.50, meaning my break even was going to be around 24.32, 24.33, which wasn't too bad. Well, on Tuesday, the stock kept going up and it went as high as into the 28s and even touched 29, which meant that if I had just simply bought it on Monday and sold it on Tuesday, I would have made more than on the covered call. But lo and behold, the stock turned around and went from 29, and starting on Wednesday, I started losing money, and then Thursday, I lost a lot of money, and it was going down, down, down. So I decided that I did not want to ride this thing all the way down. Remembering last March, I rode several of my stocks down a tremendous amount, so I wanted to get away from that. So I bought back the call at 40 cents, and then I sold my position at 22.17. This resulted in a loss of $510 for the 2 blocks, but if I had not done covered calls, my loss would have been $730. So the covered call helped alleviate some of the loss. So it can help you with losses as well, but it limits your upside. And for a while on Tuesday, I had a better upside than if I had done the call. So this is a very volatile stock. I did mention it was a volatile stock. I will not look at another pot stock again for a month. It can't be moving 25% in a week. That's just too much. And then the cover call strategy, that works better when the stocks are moving 5 to 10% in a week. You capture some of the upside. Even if it goes a bit above that, you don't feel like you've left a lot of money on the table. All right. So Carnival Cruise Line is my stock of the week. I think I can buy it around $26.50 at the open on Monday. Right to 28 call, get about 47 to 50 cents per contract on that. I'll probably do a couple contracts. I might do 2, 3, 4. We'll see how it looks on Monday. And then I'll report back on it again next week. Please like and subscribe to my channel. I hope that you like what you hear on Covered Call Corner. And if you're looking for more basic investment advice, I recommend that you search on Derek Benson. Derek, D-E-R-E-K. He is my son. He has an MBA from the University of West Florida, and he does great basic investment information. And you can listen to his opinions as well and take all of this in stride. Hopefully you found this informational, and I hope to see you again next week. Thank you for listening.